Good morning, everyone. Andrew Marquis, Cross Country Mortgage. Hope you all had a good week last week. I was off on vacation with my family in Costa Rica and excited to be back and help you all out with the real estate market this spring. So starting out with our Monday morning rate update for everyone, quoting conforming rates with 1 point. I have a 30-year fixed at 5.95. I have a 15-year fixed at 5.49. Moving into the jumbo category, 20% down with 1 point, 30-year fixed, 6.125, 10-year ARM, 5.875, 7-year ARM, 5.75, 5-year ARM, 5.5%. The hot topic for the week to discuss is loan level price adjustments. So there's been a lot of publicity on the news about this lately. I do think it's more of a political stunt than anything else, with the conservatives talking about Biden and changing the way loans are priced, making it more expensive for people to buy homes, people with better credit being penalized. And I would say a lot of it is, what people say, like an echo chamber. And for the more accurate information, always come to a loan officer such as myself or someone on my team, and we can help you out with the accurate information on the street. But here's the way it works. Loan level price adjustments are risk-based pricing adjustments based on credit score, down payment, property type, loan amount, etc., based on where you're borrowing. So, two customers that are buying with 5% down might get slightly different rates depending on their credit, the property type, their history, etc. And so what the administration has done, and these are loan level price adjustments that really took place last December, these were announced. They're just recently becoming a hype in the media because they go into effect May 1st, and we're in a political, climate right now where people are starting to use different things to help their parties. So these loan level price adjustments, what they're really doing more than anything else is evening the playing field. And what I mean by that is clients with lower credit scores are actually getting less pricing hits than they were before this adjustment. Clients with excellent credit are getting a few additional hits. So what it's doing is it's making it someone that had a really not as good a credit trying to buy a home, it's going to be less expensive for them moving forward on a conventional loan. It's also less expensive for them on an FHA loan because they pay lower mortgage insurance premiums. Those recently changed. The borrower with the excellent credit might pay a little bit of a pricing hit more than they were paying before, but it's very, very minor. And it could be, that could get absorbed into rates, going up and down day to day in the market anyway. But it's really evening the playing field. There's going to be less of a pricing discrepancy between the guy with not so great credit and the guy with excellent credit. It's going to be more even moving forward. The other silver lining to this, which is a huge benefit, is loan level price adjustments are completely waived for first-time home buyers that make below either 100% or 120% of area median income in high-cost areas. So most counties around Boston, talking about Suffolk, Middlesex, Norfolk, Plymouth, Essex, they have what's called a high-cost county where we have higher loan limits. And so we can lend up to 120% of area median income, which is $159,000 for a first-time home buyer, and there's no loan level pricing adjustments. So you could be a first-time buyer with not the greatest credit, and as long as you're a first-time buyer, your income is below that $159,000, you would get the same rate as a guy with absolutely perfect credit. So let's talk about that quickly. Most people say, well, I make above $159,000. My wife and I, or my spouse and I, we make above that amount, so we're not going to benefit from this. It's only the qualifying income on the file. So if we have a husband and wife or a married couple, and they each make $100,000, combined it's $200,000, but the loan qualifies under one of the two at $100,000, we would simply not use the income and employment of one borrower on the application because it qualifies with just one, and you would then meet this LLPA waiver, loan level price adjustment waiver. So there's a big benefit. I don't think it's worth all the hype the media is giving it, but the media loves to publicize these things, especially given the political climate out there. So if you have more questions on this topic, rates, or really any other, please don't hesitate to reach out to my team and I. We're always happy to assist. It's www.themarqueeteam.com, and hope you all have a great week ahead. Thanks so much. Bye-bye.